Um, my name's Michael. For those who don't know me, I'm out in Scottsdale, Arizona, one of the founding members, along with Brandon and Joe. And Christine is our lovely how do I put it this? Human resources, relationship capital. She's the one who basically is the glue of all three of us because three men doing things at times are not always the best. So we appreciate her very much. Appreciate you guys jumping on. Today we got a new opportunity. If you're not familiar with our strategy yet, Joe is going to be informing you about it. This is not our deal particularly. We're co-GPing on it. It's a company called Rise 48. They're here actually in the Phoenix area where I am. When I should say here and be more specific, they're near us, and good guy. His name's Zach, and they've been doing deals for a while. They got an office in Dallas, Texas as well, and that's where this deal is actually located. 176 unit down there, and we feel good about the team over there. Right? They keep getting deals, and they have a good long history. I've asked around about him and Rise 48 in this network, and all got a great response. So we feel good about partnering up with them and presenting this opportunity to everyone on this call now and everyone who's going to watch this recording as well in the future. So hopefully we can answer all the questions. Please feel free to ask whatever you want. I'm going to kick it over to Joe so we can start with the high level of this deal, and we'll get right into it.
Perfect. Thanks, Michael, and appreciate everybody being on here. I just got to say that I am very excited about this deal. I am a nerd when it comes to multifamily and numbers, and there's a lot about this deal that really makes sense from a risk and return perspective. And so we're, as a team, as UPC, we're really excited to introduce this as our deal for you guys to possibly invest with us if it makes sense right now. So I'm going to share my screen really quick, since we were talking about, Porsches earlier. All right. So this deal, let's start with the team, and I will be sending this deck out to all of you if I have not already. So we'll be going through it. So Rise 48, their company out of Phoenix. Zach Haptonstall, right, is just a couple blocks away from where Michael lives. They started this company back in 2019, and to date they have acquired. Let me find the slide. You can see right here they have acquired $1.7 billion worth of assets in 2019 and have exited. They've had 11 successful exits, right? So that's one piece of the puzzle, is the team. And that's really, the team is what makes or breaks the deal. And you can see from the track record that these guys have had that if you look at their projected returns to their actual, and right, you can look at this a little bit deeper when I send you the deck, but they have absolutely crushed projections. The other thing that's really cool about these guys is, right, their office is based in Dallas and in Phoenix, and they have what's called economies of scale, and they are vertically integrated. Vertically integrated, if you don't know, means that they have property management in-house, they have construction in-house. What that does for an operator is it gives them the ability to have ultimate control over third party, the services, the construction costs, the property management. So like other deals that I've owned, I have a third party construction, I've got a third party property management, and so I can't control that as much. So that's another way that they're able to control cost. Another item that I really like about what they do is, of course, right, they have their office there, is that they've got this figured out to where on each property, they just rinse and repeat what they're putting into these properties, and they're able to get wholesale costs for all of their materials, right? If you're renovating 500 units at a time, or have 500 units, and they all need renovated, which they have in Dallas now is 500 units, your cost per unit to renovate goes down, which at the end of the day will increase the return that the investors are able to obtain. So that's a quick overview of Rise 48. I feel like there's a lot of synergies with what they're doing, with what we're working on. Now, to the next part with the deal specifically.
And real quickly, guys, just because Joe actually informed me, because Zach is down here next week, we're gonna have another prevent investor meeting. If you don't jump in with us before then, you want to get to know them. He's going to be joining the investor webinar with us next week, so you get to hear right from Zach about him, his his portfolio, and more about the team's philosophy.
That's right. And he may come to our barbecue next Saturday as well.
Oh, amazing.
The other thing too is Rise 48, these guys, we didn't get in early enough, but they just closed a 252 unit, literally a mile away from this deal today. So now they officially have 500 units in Dallas, which is really exciting. So going to the deal level, Zach was telling me that since November, they have underwritten over, what was it? Like they've underwritten over 110 deals, and there's been only 4 that have penciled, this being one of them. Now, the second part to any good investment is, why is this a good deal? What's the story behind it? This deal was bought 3 years ago originally by another operator who bought an interest rate cap for 3 years, right? And they projected like a 6.5% interest. What happened is, as we know in this day and age, if they were to refinance, their interest rate would go from a 3% to an 8%. That gave Rise 48, or Zach specifically, his team, to come in and buy this deal at literally 30% off of what it would have sold for in the fall of last year. So highly distressed seller, because they were going to lose their shorts on it. They were able to bail them out and obtain a really, really great basis. The other upside to this deal is that there are significant operational upside. Now, let me find my spreadsheet for that really quickly, and I will show you what that means. I apologize, I'm not as familiar with their deck as I am my own, so let's see. Oh, right here. Okay. So 100% of these units are classic, meaning they have not had any significant repairs or renovations done. So where they haven't done any renovations and there's operational upside, what Rise will do is pretty much from day one, they have the ability to go and take a unit and increase rent $105 without doing any construction, which is really big. It's not often that your loss to lease or your market rent increase is higher than your renovation premium. What this means, and this is a huge opportunity in my eyes, because essentially Rise 48 can come in and they can decide how many units they want to renovate versus how many units they want to release at the higher rate, right? This also controls vacancy. The higher the vacancy, the lower the return to investors. So this maximizes the ability to have maximum NOI, right? It's pretty much, they can do whatever they want to and need to with this property. Okay, so that's kind of the deal level. Some more specific, right? Bunch of 1-bed, 2-beds. The third piece to an amazing investment is the location. Now, the location, you will see that it is very close. See, can we all see this? Michael, can you see my screen fairly well?
Yeah, can.
Okay. So you can see right here, this red ticker is the Rise Oak Creek deal. And then the smaller blue one is the one that they just bought. And it's also just a mile away from Bedford Lake. It's close to a really big airport. and there's a lot of medical jobs, lot of jobs and growth in this area. And they even go down to the neighborhood, right? You can read about it here, but the location is for Bedford and for Dallas, Fort Worth area is an exceptional location, right? So they're just, batting 100 here with the team, the deal, and the location. Now, the fourth part to make a great investment is the returns. And that's ultimately why we're all here, right? It's like, okay, this is great. It's a great story. It seems like a really great property. What's in it for us, right? How does this make sense for what I'm looking to do? So the investment options that we have there's essentially three classes of investment that you can do. Class A is $50,000 minimum investment where you get a straight 10% cash on cash and with no upside, right? You're hedged. It's practically a guaranteed 10% return. Okay. Now, Class B is a $50,000 minimum. That's a 7% preferred return with a 70-30 split. What that means is you invest, say, 100K, you're going to make 7% on that money, which is $7,000 a year, and so you have to hit that. So say year one is 5%, you're owed 2%, that's going to accrue into other years, right? Class C is 500K minimum where they step that up. So it's an 8 pref, 80-20 split. So from what I've seen in the market, these are actually really great returns. Now, some questions that I got earlier is, around cost segregation. Now, as I know, Brandon and his colleagues, most of you are also interested in, okay, well, what does depreciation look like for me where, I'm a smaller investor in a $12 million raise? Essentially, you will be able to receive just as much depreciation as all the other investors. And from talking to Zach, he told me that for the 2022 calendar year on K1s, they were able to return 60 to 80% of the investment dollar back in depreciation. Now, there is a step down happening this year based on one of Trump's original rules around depreciation. So he said to plan on roughly 40 to 60% that you can assume in depreciation, right? And the way that we're going to get that is by doing a cost segregation study where we accelerate the depreciation on the property. I guess where we're doing this a little bit more casual, are there any questions at the moment before I go on to the next part? I know the returns are what most people are interested in. So any questions?
I mean, has anyone got any questions about the 70-30? If you were to jump into that level, or even the 80-20, does those things make sense? And if it does make sense, awesome. Sometimes people who watch this recordings, they get a lot out of the questions as well.
Yes.
So I have a question.
Please.
So the exit strategy is 3 to 5 years on the money. So you're making 7%. Let's just say for easy math, 100,000 is invested. You're making 7% cash return per year. And then let's say on the 5th year, when you're getting out of let's say the property gets flipped, what happens then?
Yeah.
What is that?
Great question. So the 70-30, the 70-30, you actually can receive that from cash flow as well, right? So the 7% preferred return, let's call that a hurdle. Once that 7% return has been met, and whatever net cash flow is available after debt service, that's like net cash flow, the investors receive 70% of all net proceeds. That's cash flow, that's refi proceeds if there's any, and sell proceeds, right? So for simple, easy math, Alejandro, say we were doing a deal and on the exit, say we raised $1 million, okay? And there was $1 million profit, you brought 100K, so you own 10% of that investor pool. That means that 70% of the million profit goes to investors, so that's 700K. Since you own 10% of that equity stack, you would receive $70,000, right? And the same thing for cash flow. If there's, say, 10K at the end of the month, that's net. Investors receive 70% or 80% of that, depending on what class you're in. Now, and then that's how ultimately, if we're to look at the overview of returns for a Class B share, that's how you're able to obtain essentially a 2x multiple. You put in 100K over this 3 to 5 years, you receive an additional $100,000 on top of your original investment of $100,000. Does that all make sense?
Yeah, that makes sense. Thank you.
Great. Yeah, of course. Now, one thing that I will tell you is, and two things that I'll mention that I really like about how Rise 48 has structured these deals. And one of them is so it's a 5-year deal, right? They have, let me find the slide really quickly. The financing that they got is quite exceptional. And I think it's very creative how they were able to do this, right? So they're buying it for $25 million. They're putting $5.3 million into it. And they have an interest rate of 4 3/4. Now you may say, dang, that's like really low for the economy. Well, Zach and his team are extremely intelligent. You think that you would be, after $1.8 billion of assets. What they did is they bought an interest rate cap so that if interest rates go to 12% for the next 3 years, it stays at 4.75%, which is really big for cash flow. Now, in 3 years, what they've also projected is that they are planning on doing a refinance at the end of year 2. But the beautiful thing about it is they are, and with the refinance, they're not planning on giving any investors money back on that refinance. And the reason because of that is they want to be able to show what this would look like if they never did a refinance, right? The only reason that they would do a refinance is to buy another, low interest rate cap. Now, if there is an option to be able to receive money at a refinance, the returns projected here will go up significantly. Okay. And Zach was telling me that one of their hurdles, that if they hit if they say in year 3, they hit a 20% AAR, which is an average annual return, they will most likely sell the deal, right? If they get anywhere between a 20 and 25% AAR, which will equate to like a 3-year hold. And then they give our investors the ability to 1031 into the next deal, which is also a huge pro. So those are a few things that we really like about the deal. 1 is the team. 2 is the deal itself, the story, the business plan around what they plan on doing. Number 3 is the location. Number 4 is the return to investors and the debt financing that they were able to receive. So in my perspective, from what I see on this deal, they're underwriting very conservatively. They've put a lot of pieces into this deal to make sure they hedge risk, right? With the interest rate caps, with not projecting a refinance into their returns. There's a lot of things that they're doing to hedge risk. And this is like the baseline of returns that you can expect to receive. So for all of those reasons, is what make this deal a fantastic opportunity for anybody interested in being a part of it. And lastly, I will say this before we do Q&A. As you know, the one thing that we like to do to make ourselves different than those around us is we are all about, if you read our post today, we're all about giving back. We're all about generational wealth and, putting our best foot forward and helping others around us. And so part of our fund is that the net proceeds that we will receive as a fund, 5% will go back to my nonprofit, Tiny's Tribe, who Michael is also a board member on, to helping local families with that have been in some kind of tragic incident or accident, and helping them, find a new life, essentially helping them move forward with whatever tragedy it is that they're going through. So, and we've had a lot of fun doing that and have helped quite a few families. I think to date, we've raised and donated over $120,000 to families in the last 2 years. So our passion is multifamily and giving investors great returns, and then being able to take that and giving back to those around us. So that's what I have for you. Is there any questions?
Just one last question. I know you touched on it really quick on the K1. Can you elaborate a little bit on like what exactly, how does that work? I know I asked you a few questions when we were on the phone, accelerated depreciation and
That's
all
right.
that. So that's just because all those units are going to be renovated and they're going to grab the money that they're going to be able to depreciate that in the 3 to 5 years that were invested in there.
That's right. So a cost segregation study, and like we talked about, but I'll for sure go over it. Straight line depreciation on an asset like this is, I think it's like 39 years or 30 and a half years, straight line depreciation. Everything in this property is not going to depreciate equally, right? You have appliances, carpet, flooring. I mean, flooring is carpet, nails, siding. I mean, everything is going to have a depreciation life different than each other. So accelerated depreciation is essentially digging deep into what those renovations are and depreciating those items in an accelerated fashion. And it's usually across 5 years, 7 year, 15 year. So by depreciating those items in that accelerated form, it gives investors in, year 1 through 5, the ability to receive more depreciation than just taking it if you were to do it on a straight line, where everything would be treated equally. Does that make sense? And so they'll do that. It'll be a professional study that's done, and then we'll give, Rise 48 and say, okay, you can expect to receive this percentage, and then of cost segregation, and that will result in a percentage of, per dollar that you put into it, right? So what Zach said to expect is 40 to 50, possibly 60% on the dollar that you invest. Granted, right, he's being conservative. He got 60 to 80% last year, so it very well could be higher. We just want to be conservative in what we share.
Got it. Thank you.
Yeah, you can think about it. I mean, we there's people out there that have 1099s. The K1 really is just it's because you're an LP, limited partnership in this, and that's going to show within the fund what you can depreciate. So that's what the form is there for. Are you guys following us on social media?
Ooh, yes.
Yep.
Nice. Appreciate that.
If you're
Trying to grow
not,
your social media. So if you're not, it's simple. Upgrade Partners Capital, all like underscore hyphens. Um, but yeah, any other questions? I mean,
Just kind of a broad opinion question for the leadership team here is
please.
how does this relate against the deal that just closed yesterday for similar property in Dallas? Is it really, I didn't really look into the slides just yet, but is it right in line with those estimates?
It really is. It's interesting because I was like, Zach, is this deal from the same seller? It just happens to be that it's two completely different sellers. But most of the deals, like metrics for cash flow for renovation, are really the same. I mean, they could have been a brother sister property without really knowing it, by the owned by the same investor. But as far as metrics and their business plan, it's all the same.
I
It really
think there's a
is.
little bit more of a value add opportunity with this one, from my deep dive with it. But you're talking same marketplace. I think they're what, maybe 3 to 4 miles apart, Joe.
They're 1 mile.
One
They're
mile
1 mile
apart.
apart. Yeah.
Thank you. So we're talking same marketplace, as Joe said, a lot of about 90-95% similar. Just the value add, the 100, I think there's like 100 units, if I remember right, Joe, that are
176 units they're all classic. So right, that's stated right here. 100 upgrade 100% of units.
yeah. So the value add opportunity, I think, is larger in this play, which obviously gives us a better return.
Yep. So what they're gonna do, right, is they're gonna come in and do exterior first, make the oh shoot, what's it called? They're gonna make the exterior sexy so that it's curb appeal. There it is. They're gonna make the curb appeal look really nice so that it's more inviting for the clientele that they're looking for. Then they'll go in, renovate units, and then do capital repairs as they go. So
Yeah. I
uh,
mean, I would say the reason that, I mean, it was really timing, Tom, that we didn't jump into the last one. We had just gotten to know Rise 48, and the timing was very quick, and that's why we didn't jump into the last one. But this one came up, right away after, and since we got to know, felt good about Zach and the team. We're like, oh, very similar metrics, and we like the team, so that's why we're presenting this one.
yeah, and you
Yeah,
can
that's great. Yeah, the Rise 48 team really presented well, and they've
right.
got a solid story.
Yeah. And I mean, who doesn't want to do, one of their first apartment deals with a $1.8 billion company that, there's just so much more potential to do more deals with them, right? This is all about relationship too. Like he's like, I got another Dallas one coming, that, if this one is successful and you guys like it, your investors like it, we've got another one ready for you here in another month or two. So which really helps this deal too with the economies of scale.
Yeah,
So
I also think they're positioned themselves well. I think we can all maybe agree that there might be a little bit of a because commercial space right now is taking a hit, office space is taking a little bit of a hit, and the way that they're positioning their financing and their leveraging, they're still be able to find a lot of these nice value add deals. I don't know if they're using AI, or if I don't know if they just got amazing relationships on ground, but they're still finding these very nice value add deals in this
yeah,
economy, which is lovely to see.
and I can speak to that, Michael, really quickly. They have very good relationships with the number one commercial broker in Dallas. The way that reason I know this is another relationship of Michael and I's, Obsidian Capital, who are based out of Austin. They were at a NMHC conference, which stands for a National Multi Housing Conference, and there was an exclusive event that only a few operators were invited to with the top brokers. So Obsidian Capital was invited, and these guys were invited, and so our contacts with Obsidian, right, know these guys. They got a deal from the top broker and Rise 48. So both of these deals that they just closed on and this one and the next one came from the #1 broker in Dallas. They had zero competition on buying this property, which is it's awesome. So
Magic.
yeah.
Well, I know that
Michael, one last thing.
Oh,
Sorry.
sure.
I'm just one thing I missed, guys, the timeline on the deal. Okay. Today we are April 27th. We need to know who's in by May 4th, which is when we're doing our next webinar. May 16th is when we need to have the documents executed. You'll do that in our investor portal. A few of you have already done that. If you are interested, let us know. We will send you the investor link, and Christine will be so glad to help you get your investor portal set up, help you through the process. May 19th, make sure you have this down if you are planning to invest with us now, is that you will need to have funds ready by, I would say, a couple days before May 19th. And they plan to close by May 31st. Now, one last question or statement is distributions. You know, when do we pay, get paid? When do we get paid and how, right? So they will be doing monthly distributions. They say, based on this timeline, to expect 90 days from closing to get your first distribution. But they said, we just closed on a deal like February in Phoenix, and it's like 45 days and there are starting distributions, right? So expect 90, you could possibly get less, or it could be sooner. It could be sooner that you could receive distributions, but plan 90 days. Okay. Any questions on the timeline? Okay. Well, if not, we appreciate you guys. I think most all of you have our contact information. I'm just going to put this up really quickly so you can take a screenshot of it if you need to reach out to one of us.
Joe,
And
I'd like to make a little
Chris.
note before you pop everyone off.
Yep.
So we would love to send this deck with the property, and you can review all the details, but also include our investor survey so we can truly get to know your goals and your desires with your personal portfolio. So we'll include that in the email.
That's right. Okay. Well, thank you all. I guess I'll ask really quick. Any questions? Clay, you got any questions? I'm gonna call you out.
Only 3 people.
Good. I guess I just want to look at, like, do you have an address, or can you send me the address? I was looking it up I was trying to Google the location,
Yeah,
just where all the other rentals are in Dallas.
that they
Just to kind of,
that they own.
no, just all of Dallas. I wanted to see what, like what's the vacancy rate in Dallas, and I was curious how
Yeah.
the place was going to rent. So just kind of doing
Yeah.
due diligence on
So
the area.
It's let's see, I'm not sharing my screen. So here's the address. And in this deck, Clay, you will actually down here closer to the bottom, they have rental comps for you to check out as well.
Oh, okay.
So they got rental comps and sales comps. And they even have an explanation on, vacancy and loss to lease and all that in here as well.
Cool. Okay.
You're welcome to do all the research that you'd like.
Okay.
So have I sent you the deck yet, Clay?
No.
Okay. I'll do it right after this.
Okay. Perfect.
Okay. Thanks for the
All right.
question.
Thank you.
Okay.
Looks good.
Perfect. Thanks all. And we'll talk to you soon. Have a good day.
Bye.
Thank you. Bye.
Bye.